Well, the question on everyone's lips is, will Australia finally succumb to a recession this year? It's a question I've asked previously, yet Australia just keeps defying the skeptics. It is now 25 years since we last experienced a recession. There is a reason for that though. Based on the standard definition of economic growth, it makes it very hard for Australia to go into an official recession right now. Here's what I mean. The economic growth numbers you see published in the media once a quarter measure Australia's economic output. That is, they measure how much stuff Australia produces, while ignoring the profitability of that production. For example, over the past few years, Australia has experienced a commodity price bust. But before the bust, we invested billions to expand production in things like iron ore and natural gas. Now, those production increases are kicking into gear. But with the price of these raw materials very low, the actual benefits of this increased production are minimal. Yet the economic growth numbers ignore the price we receive and just measure the increased volumes. And because the volumes are higher, it adds to economic growth. That's one of the major reasons why Australia's headline economic growth has defied recession forecasts. Thanks to rising iron ore output, we've defied the doomsayers, like me. But if you look at the alternative measure, the one that takes price as well as volume into account, the story isn't so remarkable. In the year to the 30th of September 2015, economic growth contracted by 1%. That's a recession in anyone's language. Even so, the day of reckoning for the traditional measure of recession, the one that you read about in the papers, is getting closer. There are ominous signs. The first is China. It is struggling to contain its massive credit boom. On the way up, it was hugely beneficial for Australia, but as it deflates, it will have the opposite effect. The second sign is in the stock market, which is probably the best economic forecaster there is. In early 2016, the ASX 200 broke down to new long-term lows. It was more than 20% off the peak reached in April 2015. It's never a good sign for the economy when the stock market is so weak. And if you break it down even further, the two sectors most crucial to Australia, the resources and the banks, don't look at all healthy. Let me show you two charts. The first one is the ASX 200 Resources Index over the past 3 years. From a peak of nearly 6,400 points reached in 2011, the index has fallen nearly 70%. That represents a huge loss of wealth in the resources sector. But this loss of wealth didn't have a major effect on the overall economy. That's because in response, the Reserve Bank slashed interest rates, which in turn encouraged people to take on debt, beat up house prices and increase consumption. So the financial side of the economy took over the growth baton. But now the financials, which are basically the big four banks, look like running out of puff too. To show you what I mean, have a look at this next chart. It's the ASX 200 Financials Index over the last 5 years. As you can see, from 2012 to April 2015, the sector had a very strong run. That reflected strong growth in the financial side of the economy. But in the latter half of 2015, the banks began to price in a weaker outlook. That only got worse in early 2016 as it became apparent that China was in really bad shape. And if you look closely, you can see on the far right-hand side of the chart that the index just broke down to new lows. This is a bearish sign and warns of tougher conditions ahead for the sector and for the economy. If the bank stocks are warning about tougher operating conditions, you can expect a few things to happen. Firstly, the RBA will probably cut rates again sometime this year. The big question is whether it will have much of an effect. The banks have already imposed a rate rise on property investors, homeowners and business lenders, despite the RBA keeping rates on hold. This will be an important trend to keep an eye on. If banks try to maintain their profits by hiking rates, you can almost guarantee that Australia will fall into an official recession. That's because higher interest rates will pop the housing bubble and hurt household demand. And given household demand accounts for around 2/3 of overall economic growth, any slowdown here would probably tip the Aussie economy into an old-fashioned recession. So what can you do right now to protect your wealth from this risk? Well, today I'd like to send you a free report that provides further detail on why I think Australia is about to fall into its first recession in a quarter of a century. But first, a bit about me. My name is Canavan, editor of the Daily Reckoning Australia. This is a free daily e-letter that looks beyond the mainstream headlines to tell you what really moves the market. More importantly, my team of analysts and I show you opportunities and risks that you won't read about in the mainstream business pages. In fact, we often ridicule the financial press for its conformist nature and lack of genuine insight into important financial issues. The report that I want to send you today reveals a simple 4-step plan that you can use right now to protect your portfolio from any recessionary fallout. If you manage your own money or want to keep up to date with urgent economic problems threatening your wealth, I invite you to download your free copy right now. In this report, you'll learn 6 sets of data that prove Australia is headed towards recession. The Aussie economy might be on the brink of recession, but that doesn't mean your wealth has to follow the same path. You'll read about a simple 4-step investment plan you can act on right now to protect your wealth from Australia's shrinking economy. You'll also read about Australia's 3 recession beaters. These 3 types of stocks are renowned for chalking up steady, consistent growth even in downturns. Add these stocks to your portfolio now and help guard your wealth in the face of recession. I'll show you this and more when you download this report today. Simply, click here and follow the instructions to download your free report. As I mentioned earlier, this is a free daily e-letter written by me and my colleague Vern Gowdy. If you're worried about an Aussie recession, you'll love Vern's work. He's a no-nonsense analyst who's seen it all before. Sign up now to get your free report, and thanks for watching.